So this isn't necessarily fitting any strategies. This doesn't fit any of the conditions, but this is the requirement of a mindset that you should take in the approach, right? So just bare bones without adding any kind of bias towards what you know and what you understand. It's just taking in information. How do you take in information? So we can agree that candlesticks is a form of language, and it's also the visual representation of price. And that reflection of price is the visual representation of human psychology in a commodity, right? Whether that is a product or whatever the price is measuring, I guess. So these candles are measuring the NQ, right? The NASDAQ. Right now, this is the day before, which was Friday. So we had a whole weekend in between this price time. And then we have Sunday here, right? 6 p.m. So a whole weekend has went by. We can subscribe to the idea that maybe you were mad on something, mad about something on Friday. Will you still be mad about it on Sunday? Right? That's enough time for a lot of people to cool down, unless like you're just truly a hatred person. So if we can say that we can cool down and just come with a fresh mind, then we should also treat price the same way. We should not try to take what happened on Friday into fruition to what will happen on Sunday, because we want Sunday to allow a new fresh mind for you to use. So in my trading philosophy, I need data in order to interact with the market. So here's 6 o'clock and we get a large shoot down, right? First thing I'm noting every time, this is the start of a new market. So this is technically the new high that we know of. Now we need a new low. You can't get a low until it's finished dropping. Right now, you can see this finished running, so that is the high. There's our blue candle, so now this is finished dropping, so this is the low. This is what we call the set, right? We have set a high and a low for our new market data points. So at this point, there's a lot of assumptions we can take from this because, again, we need to speak the language. So this is a high, this is a low. The next thing you need to know of is a midpoint. Whether you want a super accurate midpoint or you eyeball it, you would just look for that 50. All right, so here's that 50 point. Let's just draw a little yellow line. That's our midpoint between the high and low that was created. Now, we cannot interact with this until we have data. So we need the candlesticks to do things. There's our midpoint being established. There's our midpoint being retested. We're falling before the high. There's our midpoint again. Now, what is the data set telling you? We just identified that this is the midpoint, broke through it, retested it, right? Without adding the trading brain to this at all. We're just doing the consumer brain first until we're outside of the consumer market. Here we are. Fair value is being protected again. And we're at a new high. So now this goes to show you that initially market dropped for a low, created its low, created a fair value, and is holding fair value. So your sentiment here says all of this is pretty bullish on the fact that this product isn't going to a low and we're interacting with the higher margin of premium first, right? All of this is expensive prices. All of this is discounted prices. Now, what part of your trading brain can you idolize an entry or an exit in order to take us either A, out of this range, or when we do get out of the range, how can we enter it and follow suit with where the market will continue to go? So here's your breakout, and here's a bunch of displacement, which we like to call order blocks, right? So we're just watching market for entry points. If you can get one, maybe that was one for you. Here's your order block, right? That could be your re-entry experience. Realizing, again, this is a 6 p.m. market. Tokyo manufacturing doesn't start until 9 for us. So let's go through an assumption of saying maybe Tokyo will not even interfere with price until 9 o'clock. So this could just keep going higher and higher. So the consumer market gave you the reality of the product. Now here comes 9 o'clock, our first interaction, our first customer. This guy, he's got a set price too. So it's slowed down a little bit here. Ideally, if we're using our conditions now that we're finally in the space to use our conditions, we can turn on our indicator, which would show, okay, this is Tokyo market. So we need data from Tokyo market. We have the initial Sunday price that was given. We have its interactions. Now we get the manufacturing experience from those interactions. So maybe you can use some of the displacement from the day, the trading day that you were given, not the trading day from the previous, right? Here's Tokyo giving you all these interactions here. And we're kind of getting a level that has taken place, top and bottom here. Can open the screen up a bit more. And now it's playing on the level a lot. We've already touched a premium, a premium, a premium. This is fair value. If we end up under fair value, then we can expect to go a little lower from that experience, right? So here's fair value. There's your retesting experience that we are not allowed to get back above until we touch either new discounts or order blocks in that case. And then we have another session, which would be London. That would be at 3 o'clock. So you got your new discount here, and you can see again, interactions, too many that are not going for any higher pricing, pushing lower in prices. So before we move into London session, just looking at this and what we've ran through already, this again is just for us to look at the language. It's just for you to tie in, how do candlesticks talk to you and tell you things? What information can you gather out of it? The more intuition that you use, the less attention you will pay to the data that is given, right? Because you're looking at large runs and large drops versus these candles are struggling at this particular level and showing you that they're struggling there, or at this level here, which maybe aligns with the last point of struggling, right? You can see these drops and these drops. So when you pay attention to this data, you can see and articulate the candle saying, we will not go above this point, we should explore lower, or we will not go below this point, we should explore higher. That is the consumer brain that would allow you to understand the language. So if you can use that and also add in the trading brain, now you can add the sauce of models, right? So if you did have maybe your 1 and your 2 here, and you have that kind of intuition that you've now created with the data, you can see the language that is being spoken by the candlesticks. So if they can't break this, then they're probably going to go through a manipulation experience, 1, 2, 3, right? So London session is going to open now. Once London session opens, it's under the level. So if it started off under the level, it eventually needs to stop somewhere, because again, this is a new market. So now you have a new high for London. And then eventually it needs to stop falling and create a bottom. So it's getting a drop. You have to let the price do what it's going to do best until it stops. There you go. Now it stopped. So let's turn off the indicators so you can see it better. Here's the highest point of London. And here's the lowest point of London. And if we were to do that whole fair value experience again, you take the highest point and the lowest point, and look at that. That yellow line will be our fair value point, which was our fair value point initially from the first opening experience. So now London was able to get a deeper discount in that aspect, right? Just articulating the language, not really trading yet. We need to get above this, and we have our 1, 2, 3 here, right? Which we know is a model. So if we can get above that, then our bias can be more towards the upside if we're using London session. This is not the 936, so we can't use 936 terminology here, but you can see the interactions with the levels itself and how candles are interacting with it, right? You can see the rejections from the model, declining price product there. This is fair value. Here's your deepest discount. So you know everything under here should push you higher. And you know everything touching this trend line should try to push you lower until it's above. So just like shopping, you're looking for discounted areas. Look, this could be bias because it's in a discounted area. Can it go back above the level? If it goes back above, then you're headed the right way. But now this is the highest price that London consumers know of. So they would need to interact with that price to know to shoot this price down. They interacted with it. If they can't get above it, then they more than likely will push it lower again. And then you're going to push into the next consumer market, which is going to be 6 o'clock. That was 6 o'clock. Okay. So we passed it over to 6 o'clock at a high. You can see the interaction with London. You can see the interactions with New York's trend line. And now we're in a whole different market once again. If we got rid of all the old data and just keep using your brain, your trading language, I guess, and consumer mindset to articulate each session, right? Give yourself the first 10 minutes of a new session to just take in the knowledge. Here's the high, here's the low. Once you have that established, how do they interact with it? Do they go for the new low? Do they go for the new high, right? So with that data, it'll allow you to move through each session. But eventually you are going to have your Tokyo, your London, and your New York, which allows you to do that on a macro perspective. And that allows you to take like really big trades versus staying in the smaller spectrum, which is still feasible if you're trying to take trades within the trading day. But if you're looking for the biggest bias, you want the most data, right? But hopefully that helps with the ideology of understanding how price interact.